What is going on, investors? Hopefully, guys are doing well out there. Earnings season's just rolling right along here, and we're going to combo three companies in one video. We're going to take a look at MasterCard, we're going to take a look at Visa, and then we're also, I think on the first here on the channel, going to take a look at American Express. So you can call this the credit card earnings recap show, and they are timestamps down in the description below. You're more than welcome to jump to the stock that interests you the most. Let's kick things off with MasterCard, ticker symbol MA. Over the last year, stock's up actually 9.3%. What I'm doing is looking more over the last 6 months. This stock also up about 9%. The company reported their Q4 earnings, I believe, yesterday. Revenue came in at $5.8 billion. That was 11.5% year-over-year growth. It beat expectations just by a little bit, just fractionally by about $10 million. Now, for the upcoming quarters for MasterCard, looks just absolutely consistently solid, just kind of mid-teens growth, and the company didn't really give any indication that investors really shouldn't expect anything other than this kind of low to mid-teens growth on the revenue side. You are going to take a little bit of a dip in the upcoming quarters on the earnings side, but then that's going to reaccelerate to kind of 20% growth. Now, the reason why these companies are so good from kind of a buy and hold perspective, if you're a trader, you could trade these things, I'm sure, but really as especially a longer term buy and hold investor, if you've only got maybe like 4 or 5 years to buy and hold a stock, there's probably other better examples. But if you're looking at 10, 20, 30-year type holds, these stocks especially roll right to the top of my list because they have these massive stock buyback programs, and they continue to raise them, and they continue to execute on them because they have such strong cash flows. We'll see those when we get to the financials of these companies. It's one thing to have a buyback program. It's another thing to have the cash flows to be able to constantly be buying back the stock. The other thing they constantly do is they continue to raise the dividend. And we're talking about like double-digit type raises that are well and above, even though we're in a large inflationary environment right now. These are well above the inflation rate, up at 16.3% to 57 cents per share. And there's so much more room. They could raise these dividends by like 56% if they wanted to and still have plenty of cash. Now, that doesn't come without some risk. And this applies to all of these, but particularly Visa and MasterCard, as they're viewed to have a duopoly, which just means like two companies having the majority of the market when it comes to payment processing. And you know, look, this is true. And so you have some legislators in the House of Representatives here in the United States that are looking to disband this. And sometimes when they do this, they're just looking to raise money. They're looking to like get hush money from Visa and MasterCard. Certainly, if you look at the balance sheets, these companies have it. In this case, it looks like the biggest retailers are kind of piling behind these congressmen because obviously a big retailer like a Walmart, certainly you could throw maybe like Costco, Amazon in there. Retailers that run at super low margins are going to want to break up this duopoly and create some competition in there so they can drive down those payment processing fees. And because that chews up a lot of margin when you're only running at single digit margin, and then you've got to give single digit percentage points to Visa and MasterCard and the merchant banks. Well, eliminating that can be beneficial. And so we'll see where this goes. This has had some legs. I don't think there's enough yet to actually put this in a bill and push it over the finish line. Typically, what these guys would like to do is stretch this on for years, collect a boatload of donations from Walmart and Amazon and all the retailers, and maybe get a little bit of money from Visa. The other side will get a little bit of money from Visa to block it, and the lawmakers just kind of play their fundraising dance. I think that's the likely outcome here, but at some point, this could become a threat to these businesses if enough lawmakers get upset about it. Now, from a valuation perspective, it's not going to be cheap when you have such strong financials, which we'll show you here in a moment, when you have such strong dividend growth and buybacks, and you have a dominant position where you have lawmakers kind of questioning your duopoly. position in the marketplace, you're never going to get it at a discount. But what I notice, here's a trailing 12-month price. This is actually price to cash flow over at MasterCard. You can analyze this price to earnings, price to cash flow, very similar for both Visa and MasterCard. Well, it's been cheaper, yeah, but it's been a lot more expensive. In fact, I would say kind of the midpoint here is close to 40 times. You're currently trading about 32 times on MasterCard. We'll certainly look at that from a technical perspective here in a moment. Now, $5.8 billion worth of revenue. You're at 5.2 a year ago on a quarterly basis. On a 12-month basis, you went from 18.9 billion up to 22.2 billion dollars. The revenue growth is just going to be steady. Obviously, if you have an economic contraction, a recession, stuff like that, it's definitely going to negative impact all companies, but particularly these ones as well. Really what you want to see with these companies is they're controlling their operating expenses, and that's what you're seeing. $2.4 billion up to just $2.6 billion. That gave you solid operating income in the most recent quarter. Another reason why these companies traded a heavy multiple is off of $5.8 billion worth of revenue. More than half of it flows down to operating income, come all the way down to net income, and you're at $2.5 billion. So not quite half, but almost half flows all the way down to net income after you pay all your expenses at MasterCard. It's just really impressive. And you got your diluted earnings per share sitting at $2.62. The company for a full year pays you $2.28 on the dividend side. I think it just went up a little bit, but look, these companies can continue to raise these dividends year after year. You see, for a full year, the company makes $10.22 per share. And so, of course, they could raise this dividend by 100%, and they would still have plenty. I mean, we're talking about plenty of money to cover that. When you come over to the balance sheet, a company is looking pretty good. Now, whenever you're looking at a new company, or even if you're reviewing a company that you've looked in the past, a quick way to do things is just come down here to total current assets and see if there's a large change. There's not a large change here. It's fractional. Total assets, not a large change, just ticked up a little bit. So there's nothing really to see here year over year. So as long as you've reviewed this company in the past, you kind of understand what's going on the balance sheet. You see no large. When you see big changes here, you see the numbers change rapidly. That's when you can really dive in and see what actually changed. Long-term debt over the last year ticked up just fractionally over at this company. We can flow down to cash flows. We pull down a staggering $9.9 billion worth of net income. Again, this is a full year cash flow, 12-month cash flows. Last year, we're sitting about $8.7 billion. The impressive thing about this company is after all their add backs and subtraction, their net cash provided by operating activity is actually higher than their net income, if you believe that. $11.2 billion. So whatever these companies pull down on an operating side flows down. A lot of it flows down to net income, and then almost all of it flows down to, in fact, more in terms of MasterCard, even more of it actually flows down to net cash provided by your operating activities. It's just, these are really, really good businesses, I tell you what. Now, from an investing side, here's what gets even better about these companies. They don't have to build all these property, plant, and equipment. They don't have these large investments and these things they've got to sink all this capital into. They spent just in a year, just $1.4 billion on investing activities. So they basically didn't do anything. So yeah, you guessed it. That leaves a ton. We're talking about a boatload of money for things like buybacks, dividends, paying back debt, all of those types of things. That is why you are investing in these companies. They're incredible from a financial perspective, particularly Visa and MasterCard. American Express, a little bit different boat. We'll talk about that here in a moment. Now, from a technical perspective, this one's at the top of a range. Okay, we're up here. This stock has been basically kind of chopping sideways for basically 2 years. And the chop, the wide end of the chop is down at about, we'll call it 315, up to very close to where the stock is right now. We'll call that about 395, or plus or minusing things to make these numbers palatable, just in case you're just listening to this. So from 315 to 395, you're buying down here at 315, and if you want to sell, you can sell up here, but this wouldn't necessarily be the area where I would like to be accumulating MasterCard. Now, from a technical perspective, we have broken out. We were in kind of a downward trend and we've broken out. We'll see it more so when we get over to Visa as well. If we switch this over to a daily view on the chart, you will see we were in this downward trend and boom, we rocketed out of it. We should get some selling pressure at some point. I mean, we say that, and maybe it doesn't materialize. If you break up over 390, I tell you what, you're going to have not a lot of sellers up there and you could have some strong momentum. But at some point, you're going to get a pullback. Technically, normally on a technical pattern, you are going to pull back. There's two areas where you're likely to pull back. So this stock has been in this this is the steepest uptrend. I'm going to flatten out this uptrend because I think it's going to flatten out at some point. You're going to pull back to a line like that. More typically, though, from a technical, like a perfectly technical perspective, you're going to actually pull back to this line, which I'm going to change to purple so we can reference it. So you're going to pull back to the purple line, and it could be a very deep pullback, okay, because over time we stretch out more to the right here. We could actually pull back, in my opinion, to the 315, and you're still actually kind of technically broken out of this, and you're in the start of a new uptrend, because you would find support here, then bounce, and then makes some kind of a new high, and you're making this kind of choppy uptrend. So I would be patient with these stocks. If you're already in them, continue to reinvest those dividends, things like that. I wouldn't chase this momentum unless you're in it for the shorter term. Just make the plan now, because I promise you, if this stock goes from 380 back down here to 315, every YouTuber, every macro head that you listen to here on the channel, they're going to be like double dip recession, or they're going to be depression, or they're going to tell you the world is about to end economically. But actually, you're just making kind of a pullback in an uptrend. And so you've got to make this decision now. I would actually step in at this level right here. I wouldn't let it maybe get all the way back here. If you really want to buy this stock, there is a tiny level here at 330. If you wanted 10 shares of MasterCard, you didn't have to buy all 10 at this 330 level, but I would start to nibble at 330 and then kind of nibble on the way down. That is how I would play this one from a technical perspective. That was MasterCard. Next stock we're going to take a look at is Visa. This is one we've regularly covered here on the channel over the last year. Up 11% over the last 6 months, up about 9% after reporting their earnings. Unlike MasterCard, which kind of slid off, Visa popping up 2.3%. That's on the heels of announcing $7.9 billion worth of revenue. That was 11.9% year-over-year growth, and it beat expectations by about $200 million. Similar to a MasterCard, we're expecting kind of low double digits, sometime going into the kind of the high single digits, but kind of low double digit growth out into infinity in terms of the revenues for Visa, and a little bit more choppiness on the earnings, but at some point accelerating sometime in 2024 to kind of a mid-teens growth on that that earnings side. So things are looking strong there. Now, what is also looking strong is when we look at these credit card companies is you get a window into the consumer. And the CEO over at Visa basically squashed every macro person that is telling you we're on the verge of a depression and the world is going to crumble economically and, people are going to be dying on the streets of hunger. Well, this is what the CEO of somebody that has visibility into almost everybody's spending. He says, well, we went through what we call our planning assumptions on the last call in the last year, and we told you we had assumed no recession. And as you can see, business trends have been remarkably stable. The spend levels just around the world, they've indexed in the mid 140s for almost 4 quarters right now. And there's no evidence. Here's the CEO of a gigantic payment processor saying that there is no evidence of a change in this trend. And he says that is reflected in their second quarter outlook. He says, at this point, we're not changing any expectations for the second half. So he's talking about the second half of this year. I mean, clearly the dollar has weakened a bit, and that'll change the exchange rate impact in the second half, but we're not changing our views for the second half. He says these are planning assumptions, and if there is a slowdown, we'll react accordingly. But right now, the CEO of Visa is saying that things are looking pretty freaking good. So again, keep this in mind when you're on FinTwit, when you're on YouTube. The stuff that gets the clicks, the stuff that gets the views is we're in some massive depression, or showing you some kind of chart showing you there's just this catastrophic event about to occur. Just keep in mind, the CEO of Visa is saying, no, that's probably not happening. Now, in terms of valuation, stock's never going to be cheap, but what I did notice, here's a price to earnings, trailing 12 months. We're trading about 31 times on Visa, which again, sounds expensive, but when we roll through these financials, you're going to see why investors are willing to pay up for a company like this. Look, it's been way more expensive than that. 35 times, over 40 times, okay? So yes, it's been a little cheaper. It's been down here at like 25 times trailing 12 months earnings, but look, 31 times, you're not really actually overpaying for Visa like maybe you have in more recent times. Now, the company kicked things off with a balance sheet. They've got a boatload of cash. They've got a little bit of debt, like all these companies, little bit of debt, but overall, companies in very stable condition from a balance sheet. It's really all about these revenues and these cash flows, which are about as impressive as we see here on the channel. Revenue for the most recent quarter coming in at that $7.9 billion. We talked about how that was 11.9% growth year over year. Now, here's the impressive thing about Visa. And I tell you what, we should give the Intel CEO a call over right now. The Visa CEO should be on the board of directors of Intel and show you over the last year, your expenses went up just fractionally from $2.3 billion up to $2.8 billion. That drove operating income of nearly $5.1 billion, up from about $4.8 billion last year. So here's the impressive thing. Off of $7.9 billion worth of revenue, $5 billion flows down to operating income. And then when you flow down all the way to net income, after you pay your interest expense on the debt, after you pay your income taxes, your net income was $4.2 billion. So off $7.9 billion worth of revenue, more than half of it, we're talking about more than 50% of it, flows down to the bottom line. You just don't see this on Wall Street. That is why the valuation, there's going to be people, these stocks are too expensive. Well, what stock are you looking at that prints $8 billion worth of revenue and more than half of it flows down to net income? There's almost zero stocks that we look at that actually do that. And you see that this is a trend. While it wasn't, actually it was more than half last year. So this is a trend with this company. And then when we get over to the cash flow statement, you are going to see an identical type of thing. So you come down here to net income, you pull down $4.1 billion. We've got a quarterly cash flow statement on this company. Last year we were at 3.9. So again, just kind of ticking up that net income at a reasonable pace. Flow down to your net cash provided by your operating activities. Look at this, guys. 100% of your net income flows down to your operating cash flows, okay? And last year, similar type of thing. Because of some accounting regularities, sometimes it's actually more than your net income. So everything just flows down to the profits, flows down to operating profits, and more importantly, flows all the way down to net cash provided by operating activities. Now, things would be different with these companies if they had to build buildings and if they had to just dump a bunch of money into something. They don't have to do this. Look at this. Your net cash provided or used in investing activities was $510 million. That's basically zero. The company could strip out $510 million off these financials and literally nobody would notice. Okay, so off of $4.7 billion from the positive cash flow, you only had to invest a negative $510 million in your business. So it's like nothing, literally zero. So that leaves these companies to do two shareholder-friendly things because they don't have to invest in the business. Okay, let's be honest with you. They don't have to invest in the business. This is why you have congressmen in Washington want to break this up because this is about as good as it gets. They get to repay the debt that they have on the balance sheet and that chews up a little bit of interest expenses every year and chews down net income just a little bit. And they get to rebuy the stock and they get to pay dividends. And so to the tune of, that's over $4 billion in a quarter. So off of $4.1 billion worth of cash provided by the operating activities, a little over $4 billion worth of net income, 100% goes back to you, the shareholder. That is why this stock is expensive, is because of everything that this company does. 100% benefits you, the shareholder. $4 billion worth of net income, $4 billion worth of positive cash flow, $4 billion worth of buybacks and dividends in the most recent quarter. Similar type of thing when you look for the full year, or actually last year. So sometimes it's just like a quarterly thing, but no, this is quarter after quarter after quarter for this company. Last year, they did $4.1 billion worth of buybacks, another $800 million worth of dividends. That's $4.9 billion off of $4.2 billion. So they actually reached into their pocket, into the cash of the company, and paid dividends and bought back the shares. That's why this stock's expensive. That's why it's going to stay expensive, because 100% of the time they're rewarding you, the shareholder. Now, from a technical perspective, we've broken out from this downward channel that we've been in. It started back in July of 2021 and has been a steady pullback. We've broken out more recently from it. Now, you could chase shorter term momentum here. I wouldn't. This wouldn't be a time to add, but likely you're coming back to 250. So you probably got another $20 and run if the markets stay, a little relative momentum. They don't need strong momentum, but if you have relative momentum in here and the recession talks get pushed down, well, yeah, this thing could run up to 250. But we are likely to have pullbacks. There's two areas of pullbacks. One to this purple line, and this purple line's not drawn in here perfectly. It could tilt down, but right now it looks like it wants to set up like this. You pull back to this purple line. Over time, it's somewhere in the 210 region. Somewhere in the 210 region, I think you can buy this stock. Now, a deeper pullback could materialize. You get a pullback all the way basically to where this green line of support is, at about 189. If this stock pulls back to 189, everybody is going to be saying there's a massive recession, there's a depression, there's going to be bread lines, there's going to be World War 5 and 6 and 7 all in succession. That is why you have to make these decisions right now, because as it starts to pull back there, that is where you are going to want to buy, but the news is going to be really, really ugly. I would actually start buying this one at about 195. There's a small area, maybe even a little higher than that. You might as well just round it off at 200. If you wanted 10 shares of Visa, I would actually start buying at 200, maybe 1-2 shares, and then as it gets back to 200, there's a high probability it just keeps going. Now, it could reverse there, but the higher probability is it keeps going and you buy 3 shares, 4 shares, you complete your position somewhere in the 190 position. That's what I see. I see pullbacks at some point materializing for these stocks, and I think you actively buy them in stocks like these. Next stock we are going to look at, and I think this is a first here on the channel, is American Express Company, ticker symbol AXP, a Warren Buffett's favorite over the last year. Stock's basically flat, just up, down 1.9% over the last 6 months, though. It's been rally mode, up 13%. This one's a little bit different. So we just looked at Visa and MasterCard. This one has more debt exposure. It's a little bit more interest rate sensitive, which can be a positive. And it's also exposed to the consumer in the forms of loans. And so there's some credit risk with this company as well. So some things that you need to factor in. And these companies, while we look as consumers, we kind of look at Amex and Visa and MasterCard all the same. From an investor perspective, I would separate Amex a little bit. It's out on its own, maybe with like a Capital One or something like that as well. Revenue coming in at $14.2 billion, up a whopping 17% year over year. Missed expectations by a little bit, but what we are seeing with this company is very similar to Visa and MasterCard. Very strong double-digit growth for a little while. It looks like analysts are expecting this one to fall back to kind of a single-digit grower in terms of its revenue, but from the earnings side, we're kind of going to go flat for the next year, but then reaccelerate somehow in the back half of 2023 and into 2024. Now, the reason why you are buying these stocks, and I would put all these stocks in kind of long-term buy and hold stocks. These are fantastic companies. They continue to boost their dividends. They continue to just hit the mark time and time again. In terms of American Express, they just raised their quarterly dividend by 15%. So even in a strong inflationary environment, raising your dividend that much is definitely beneficial. You're going to go to 60 cents per share on a quarterly basis, up from 52 cents. And we get over here to the financials, a little bit different than Visa and MasterCard. Visa and MasterCard, very easy to understand. This company is a little bit different. They have some interest on some loans. They also have deposits. They also have net interest income. They have interest expense. They have provision for credit losses, and that's probably what I'll focus on right now, and then I'll take you through the rest of these. What we are seeing with this company is they're setting aside exponentially more money on these loans and the card member receivables in terms of credit losses. I mean, these are astronomically higher than where you were like just a year ago, and even quarter over quarter, we're accelerating these. And so there is going to be some bumpy patches, certainly with Amex, certainly with some of the banks as well. They're going to have to set aside more of these monies. And here is it kind of in a total view, over $1 billion just in the most recent quarter. Last quarter was 778, but look, a year ago, it was just 53 million. And so we are setting aside, I mean, they can't even tell you from a percentage basis how much larger this is because it's a huge number. I mean, we're talking about thousands of percentage points here. So the most important thing about Amex is they reported this $14.2 billion worth of revenue. But after you subtract the fact that they're anticipating about $1 billion in credit losses, their revenues were really $13.1 billion. That is still up from any quarter that we have, both on a quarterly over quarter basis and a year over year basis. Now, the key with this company is how they're controlling their expenses, because their expense on that interest, or excuse me, that credit loss perspective is continuing to rise. And, you know, if things continue to get worse, unemployment rate continues to tick up. Well, this is something that can continue to rise and then eat into earnings, eat into those revenues and things like that. So your total expenses over this company went from, on a quarter over quarter basis, 10.3 up to 11.2. So it's showing you got some pretty rapid expense expansion there. Year over year, we went from about 9.8 again up to about 11.2. So because of the provision for credit losses at Amex and because expenses continue to kind of tick up across the board, your net income number is the lowest actually that we have here on record, about $1.6 billion. It's lower on a quarter over quarter basis where you're at $1.9 billion. Year over year, you're at $1.7 billion. So you're seeing a little bit of a tick lower there. But look, I'm not concerned. It's not like I'm going to be sitting here relatively concerned about this. From a balance sheet perspective, you got a boatload of cash, $34 billion. When you see that much cash, you got to assume they have a fair amount of debt that is balanced off there. And you do see that, about $43 billion. Overall, though, you see, we talked about how the consumer, they're setting aside more money for credit losses, but you see customer deposits here are up 31% year over year. Cash and cash equivalents over this company up 55% year over year, whereas long-term debt is just up 10%. Very financially healthy, looks pretty good. This company is a little more sensitive to a recession. So if your base case is some deep recession or a depression, Amex is probably going to take that on the chin a little bit more than a Visa and MasterCard, just based on these financials, based on their credit exposure. So you just want to keep that in mind if you're going to invest in this company. Now, from a technical perspective, thing of freaking beauty. Okay, we've been in this downward channel. A lot of stocks that you have are set up like this. Okay, I bet you there's a lot of stocks. It doesn't matter what the quality of stock is. And some stocks, you know, the downtrend might be a lot steeper. This one was relatively shallow, but more recently we've kind of we've gapped and like broken out of this. This is exactly what you want to see. It looks like we're walking back up to what I have here is a red line at about 190. I wouldn't chase this stock. If you want to play the momentum, that's a whole different thing from a tech. I don't know why you're looking at the balance sheet. If you're going to play like a momentum breakout on a stock, you really should just be trading any ticker that does this type of thing. I wouldn't chase this if you're trying to dollar cost average into this, or you start a position into Amex or add to a position, things like that. It wouldn't be the area where I would chase. There is going to be pullbacks. Yes, we could potentially walk all the way back up here to 190. If really strong markets, we could just blast all the way through this and have some kind of momentum all the way up to 200 and above. Wouldn't chase it. Okay. Typically what happens is now it appears, if this is truly the bottoms that we made back here in October, and I'm convinced that that's actually possible. Okay. Whether or not it's probable at this point, I think it's very, very possible. These were the lows in the stock market back here in October. So we'll see what happens, but we will get pullbacks this way. Okay. So you get pullbacks to the top of this trend line. The ideal thing is you get a split here So over the next quarter or two, you get a pullback to like the 150s for Amex. I'd be really excited about that. Go up even higher, the pullback might produce a little bit later on. And some of you might be saying, well, why don't I just buy the stock right now? And look, if you want to make things easier on yourself and you want to buy the stock right now, sure, go ahead and do that. But what can materialize when you have these kind of gap and breakouts is this is just a complete fake out, similar to what we saw, earlier in the transition to a downtrend in this stock. This could just be a temporary fake out, and then we could come back. What you really don't want is a back test all the way to the bottom of the channel, which take you from about where the stock is right now at about 170, probably into the 120s on this one. And that would just be devastating from an investor perspective. So if you do jump in at these levels, I would be relatively cautious. It would just be a portion, 10, 20% of what you're trying to do from an overall basis. That's how I would recommend getting into a stock like this. That was American Express. That was our credit card recap show. We'll be back again later today with our FANG Stock recap show. Thank you for all tuning in. Hit that like button and consider subscribing. If you like what we're doing here on the channel, we'll see you again soon. Good luck with your investments.